We've talked about rates and the dollar kind of pulling apart for quite some time. They start to be coming back, or they seem to be coming back together. What do you think the reasoning for that is?
Yeah, I think we had a temporary dislocation earlier this year. We obviously had quite a unique environment. Suddenly, trade policy became the most important driver of global markets, which is not something that I remember kind of seeing before. And it wasn't just a one-off shift, because obviously it was extended periods of uncertainty. The uncertainty hasn't fully gone away. We've gone past the worst of it. So I think there was a big dislocation between FX and rates temporarily, and I think rates is reasserting its role as being one of the most important drivers. I wouldn't want to emphasize that it's going to completely dominate the story. I think the fact is we're seeing ongoing undermining of US institutional credibility, and I think that given that the world is still structurally exposed to the dollar, I'm not talking about short-term money which is short the dollar, I'm talking about the long-term exposure to the dollar. I think that'll continue to weigh on the dollar over the coming years. It's an expensive currency with a current account problem and a fiscal problem, and those twin deficits will weigh in it over the coming years as institutional credibility continues to get undermined.
So those credibility risks are still there, particularly when you push out to 2026. Mark, what do you make of exactly what we heard from Jay Powell and the equity market reaction as well? Strength, of course, in the US session. Looks like it's fading a little bit today. Is this a market that's expecting one and done in September, or is there something else at play?
So I think Powell, if you read his comments, from, if you came in from outer space and did not have the prior pricing, you'd go, these are pretty neutral comments. We may warrant a shift in adjustment in policy. I think that in the context that we are pricing most of a rate cut going into the speech, it was correctly taken as dovish because he didn't push back on the pricing. Here was a chance to kind of go, whoa, whoa, whoa. People have got carried away for the rate cut meeting, so the policy meeting in a few weeks' time. Maybe that's a Freudian slip. And therefore, he validated pricing for a rate cut. And therefore, it was a dovish shift. Now, what's interesting today is we're not seeing any follow-through price action. I think the price action is actually very disappointing, which is getting a little bit of a new narrative out there in the market. I think the narrative is coming from the price action, kind of going, you know what? It's no real different from a week ago. We knew that a week ago it was really the data in the coming weeks that were going to decide things, now we still know that today. The slight shift, and there has been a genuine shift, is a week ago it was, I will cut rates if the data really validates that decision. Now it's, I'm going to cut rates unless the data prevents me from doing so.
Well, speaking of the data, we have jobless claims on Thursday. We have US PCE on Friday. Does that move the dial at all?
Yeah, look, I think inflation in the coming weeks is very important. I think the more important is the CPI one, actually, in 2 weeks' time. I think non-farm payrolls, given the large revisions we had before, are really important. We've got some more adjustments coming up, kind of long-term adjustments coming up. So, yeah, look, I think non-farm payrolls and CPI are more important. But obviously, yes, even this week matters. And NVIDIA price action is going to matter as well after probably strong earnings.